Okay, so here's our webinar, um, and you would have seen this ad that I had with the for this refinance webinar, and the purpose for tonight is that with the inflation creeping in, credit card debt's increasing. It's gone up 17.5% year over year for Q1. Equifax is noticing that the non-mortgage debt for Canadian is increasing as well. This is all due to the inflation, wages, I guess, not keeping up with the cost of living. And right now, for every dollar of disposable income, Canadians owe $1.86. So debt levels are increasing. With the sec here. So the agenda, I'll introduce myself and the company I partner with, the drivers of your credit score, define what a refinance is, reasons. We're actually going to look at a case scenario, and then I'll take your questions and answers. Just so we move along quickly, I'd ask that we leave all questions till the end. We'll have about 15, 20 minutes for questions at the end, and just to move it along, we'll go through the slides first. So I have a Bachelor of Commerce and my CFA designation. I've been in the financial services industry since 1994, and I went into mortgage brokering in 2014, and it's been the best decision in my life, being able to meet with homeowners, true clients, and get to know their situation, and most importantly, being able to help them. And this year, last fall, October of 2021, I decided to move to TMG. It's a Canadian-owned brokerage. It's Canada's largest independent brokerage, and it's got 50 lenders that it partners with, and there's more than 50 lenders, but it's a fantastic company, great training, and it's great to be a part of a culture where you really fit in. I can't say enough about this company. So drivers of credit score, it's important, as I mentioned at the beginning, because it's going to determine your rate, and it's going to determine where I place your mortgage. If your credit's good, you're going to be able to be placed at an A lender in most cases, providing you've got verifiable income. If you have weaker credit, then probably we're going to have to place you at an alternative lender. And I want to point out there's 5 factors here, but payment history, that's missed payments, and utilization. If you have a credit card, say the limit's $10,000, and you have the actual balance sitting at $9,000, close to the limit, that can really impact your credit score and lower it. Things like credit mix, that's where you're going to these payday loan places, easy financial, places that you go to if you're desperate for funds. And Equifax, their algorithms, they pick this up. History is important, and with that, if you have a credit card that you've been using for many years, if you were to cancel it, you would lose all that history, and in the algorithm with Equifax, that would hurt your score. So you've got to be careful. If you've got strong credit history, you've got these cards, don't cancel them, because you're erasing your stellar past credit history. So major drivers, major shocks to your credit score. So missed payments. So 80% of consumers with no delinquency have a strong score between 685 to 850. 900 is your top score that you can have with Equifax. The utilization, if you go to 90% utilization, you could see a drop of 100 points. So I'm showing this because when I do a refinance, most cases we're paying off the homeowner's debts, credit card debt, where they had their balances near the limit. And it's amazing. After their refinance is done, the credit score jumps up significantly in most cases. So I wanted to point this out to you. So what is a mortgage refinance? In simple terms, it's the renegotiation of your existing mortgage loan agreement. So you're using it based on, you're taking the equity out of your home to accomplish a goal. And we'll talk about those goals on the next page. Some general guidelines: you can refinance up to 80% of the value of your home. That's called the loan to value. Lenders are going to require an appraisal. And for more rural properties and alternative lenders, the LTV typically will be less than 80%. Not all the time, but sometimes it will be. And I've seen it go down to 65% loan to value. So here's some reasons to refinance. You're consolidating more expensive debt into one cheaper mortgage. You provide funds to complete a renovation. You're taking out equity to purchase a rental property, for instance, or have some cash on hand for retirement. With retirees having lower pension income, and now with inflation, if they've got sufficient pension income, they may be able to qualify at a traditional lender. But that's where the specific special reverse mortgage route is an option, a viable option for retirees with limited pension income. Lenders look at the equity and can do a reverse mortgage. And the sweet spot age for a reverse mortgage is around 74, 75. With refinancing, you can support family, giving a gift of a down payment to a child, paying out CRA tax arrears, paying out property tax arrears, I got a misspelling there, paying out a consumer proposal. So those last three payouts, those are things that would be done with an alternative lender. But the important thing to stress is that there is a solution with an alternative lender. So if you've been saddled with debt, you've had some debt problems in the past, there is hope that we can place you with an alternative lender, subject to qualifying, and then down the road, ideally, try moving you from the alternative side to the A side of lending, to a traditional lender like a bank. So the costs of refinancing, breaking your mortgage, if you break it in the term, then you're going to have the IRD, the interest rate differential cost, or the 3 months interest. You're going to have an appraisal cost, and you're going to have legal fees because you're registering a new amount. So I'm going to talk to you, give you a current situation here. We have clients, they have an existing mortgage that's 1 year from renewal. So if they break their mortgage, then there's going to be a penalty. It'll only be 1 year, based on 1 year. So I'll show you what that penalty assumption is on the next page. Their existing rate is 3%. And they initially were in a 5-year term. Now they're going to be looking with this refinance. The rate is 4.84. Their rates have jumped by 2% since the end of February. So that's a 61% increase in the mortgage rate. And one of the things I want to stress with this webinar is that if you just looked at that rate, your gut reaction would be, your knee-jerk reaction would be, it can't be possible. The mortgage rate's too high to make the refinance worthwhile. And on the next page, I'm going to show you that that isn't the case. It's still worthwhile. Like with investments, homeowners tend to compartmentalize their debts. So they have their mortgage, they have their credit cards, personal loans. They don't look at the cost of the total debt. And what a refinance is doing is it's forcing the homeowner to look at the whole debt picture, consolidating their debt into one cheaper mortgage. So on the next page, I have this example here, and this is an actual example. So we have a mortgage. The balance is 319,000. Initial balance is 350. So after 4 years, it's come down to 319. That's at the rate of 3%. And the penalty to break their mortgage is going to be $2,800. So they have this mortgage. They have a car loan with a balance of 20,000, making $5,500 a month payment. So that'll be paid off in 40 months or a little over 3 years. For 3 years, they're going to have this $500 a month payment and a little bit more, 40 months. Their credit cards are one credit card is $6,000. The other credit card is $15,000. Now, lenders take 3% of the mortgage balance of the credit card balance as the monthly payment. And what that does is it allows for some payment of principal in the credit card. So it's not just interest that's being paid down, it's a little bit of principal. But even taking that $180 a month payment, $450 a month payment, you can see that it's going to take years for this credit card to be paid off. So the total amount of debt that these clients have is $360,000. Total monthly payments is $2,602. By refinancing, we're taking the entire loan of $360, putting it in as one mortgage, a rate of 4.84, 30-year amortization. So their amortization's gone from 26 years to 30 years, which is not a lot. And they're saving, their monthly payment now is $1,887. They're saving $715. In a year, that's $8,580. So we know the car loan's going to be around for 3 years. So all these loans are still going to be around for 3 years. That annual cash flow savings, the $8,000 for 3 years, it's over $24,000. And when this mortgage renews, if they did nothing, they're going to be renewing at the higher rate. They might even be renewing higher than 4.84. So this is a simplistic example, but it really shows the impact of a refinance. So I'm going to